Hello and welcome to Options Guy TV. My name is Brian Overby. I'm the author of The Options Playbook, and I'll be your host for the next 20 minutes here on Options Guy TV. Well, more turmoil over the weekend, and markets are shrugging it off once again. So the ceasefire is supposed to end on Wednesday in the Middle East, and as of right now, over the weekend, no ships made it through the Straits of Hormuz. And because of that, the VIX just is hanging out. The VIX right now is at 1923. It is up a smidge today. We got the S&P 500 index basically flat on the day. S&P-X is down $17 at this point in time. So just not too much going on in reaction to what happened over the weekend. Nothing good as far as a conclusion is to the conflict in the Middle East. But right now, we see the marketplace just kind of shrugging it off, looking to go into earnings. And oh, by the way, there was a little short squeeze that happened that was absolutely ridiculous in Avis. Symbol is CAR. If you did not hear about this, but Avis has struggled a little bit, but had some good quarters, I guess, recently, but it was one of the most heavily shorted stocks. And once again, we had buyers come in and drive the price astronomically higher. And right now we see CAR, symbol is CAR, as simple as you can get, is now trading at $509.50. It's up another 3% today. But let's run to the Trader Pro software. And I'll just show you, you almost think that this is an error if you look at the chart of CAR. So let's run over the Trader Pro software. Oh, 1 second. Let's run over the Trader Pro software, but let's show the right screen here. So 1 second. Stop sharing, and here we go. We're going to go back to the right screen, which is the chart of CAR. And I mean, if this was a ski hill, I sure as heck don't want to ski it. Let's put it that way. So there you are. Look at that. That is just I literally thought it was an error when I first looked at it, and then I did a little bit of research on it and saw what was driving the stock. But we were hanging out right about 160 here, which wasn't too shabby, but the stock has literally done nothing for so long. Let's go back 1,500 days and take a peek at the 200-day moving average. And you just see the stock, if anything, at the path of least resistance been to the downside, which would make sense. That's why it was such a short. But then, boom, just astronomical. So they're going to be announcing earnings, and I want to do a trade, and the vol is crazy. You can't even find a cheap option contract because there's not enough strikes available. So we're looking at the option chain now. We're at 505. It just dropped about $5. It's up $11 today. Earnings is in May. Let me actually grab from the chart the actual earnings date is May 6th. This is when the earnings date is, and I actually had it over here. It is going to be before or after. Is estimated report. It doesn't say if it's before or after yet, so they haven't confirmed when it is, but it's still saying May 6th. It's saying estimated on May 6th. Okay, because obviously things could happen with this much of a movement in the stock. There's a lot going on. So that's when it's anticipated to announce. We are going to look at Avis this way. I can go 200 points out of the money. And when you get this much implied volatility, you see the vols over here trading at about 200%. Let's see where the skew is at. So we're at 210 vol on the 505, the most at the money option contract. And if you go all the way up on top, we're all the way up to the 207. We're only at 203. So vol is off a little bit skewed. So there, I guess what my takeaway would be, it's good that the vol is lower on the out of the money option. Now the vol's got to be absolutely insane, 200 points lower down here on the 300. Oh, here's the 340. Yeah, 224. So the skew is obviously to the put side of things. That's 224. At the money is 210. Way out of the money on the call side is 202. So at least there's some signs that people are buying up the puts more, and they're willing to pay more volatility, more premium, because it kind of basically, when you say vol premium, you're also saying actual premium, the price of the underlying option. So at this point, I'm going to look to sell a way out of the money call spread as a bearish trade heading into earnings. Now, I looked at, maybe a skip strike butterfly in that, but there's just not much difference in price in between the option contracts. Like from 700 to 720, like that's $4 difference. Like the volatility and that happens when you get vol so high, a 20-point difference doesn't really change the option that much. I mean, it does. Like if you're looking at it, you're thinking, oh, that's 20 points. That's a lot. It's a $700 stock. On a percentage basis, that's not a huge amount. You're talking maybe 4%. But with that mentioned, I think this is a very interesting trade with this vol this high going into earnings. So let's do it. Let's sell it. Let's sell a short call spread to get bearish on CAR going out to the May 8th expiration, 18 days away. We're going to sell, and I still don't, because I lived through the meme stocks, and most of us have that are probably watching the show today. And that doesn't mean that this is over. Options. I still remember talking to a reporter about GameStop, and I remember saying to the reporter, the stock was selling off on that day after the big run up, and kind of implying that the move is over. And I remember saying, but the option contracts aren't showing that. You might believe that the big run up was there, but you still look at the volume and the open interest and the implied volatility on the out of the money calls, and people were still willing to pay a premium for them. So the volume doesn't always, it's not always going to be correct, right? But when you see vol and volume go hand in hand, a lot of times that will mean that, yeah, there's still a lot of bullish interest on the stock. But if we look at here, we got, these were probably just opened, the 700s. I don't think were around last night, and they're here. But here, look, here's the vol, and we're just not seeing a ton of open interest on these options, even around the at the money. They haven't been around long because of the jumps. And here, let me explain that better, right? Like when the stock was at 140, they didn't trade the 500 strike, right? The 500 strike wasn't available. If you were around 120, the 200 strike was maybe the biggest strike that was available at that point in time. And so every morning they're opening up new strikes based off of this move. And I'll just grab that move. So every morning they're open up, 5 or 10 or 15 more strikes above the close. And then here's 440. So then they open the 500s. Then we went over 500s. Now they're all the way up to open 700s. So the 700s probably weren't available last night. I didn't look that far out, but they probably weren't there. So we got no open interest. I need to look at the volume. I don't have the volume on this chain, but we'll look at that later. But here's going to be the paper trade. We're going to sell going into earnings on CAR, Avis. We're going to sell the 700 strike call and turn around and buy the 720. On stocks like this, it's hard for them to break through new levels like the 500 level, which we just broke through today. But usually big round numbers can be a stopping point, and I think earnings might be a reason to sell this one off. And we can get at the beginning of the show, it was 415. Now it's 350. Yeah, the markets came down a little bit. It was four. I like that $4 mark. I think I would leave it in at 415 because it was just there. I would definitely go for $4. I'm gonna send this in the paper trading platform. We're gonna send it in at 3. Let's send it in at net credit of, yeah, let's try 350. Let's see if we can get it. So boom goes the dynamite. Order has been sent. We're going to leave it in at 350 during the show. See if we can get filled at that. I might have to adjust it. The bid-ask spread's extremely wide, and this is a paper trading platform. But I'm willing to do this and take that risk. You're getting 350. Well, I liked 4. I'm going to say $4. I would work this for $4. If I'm going 20 points wide, I would like to get at least $4 on the trade. But you're risking 16 to make 4, and the stock's got to move 200 points over the next 18 days after it's already tripled. I'm not saying it's, like I said, I lived through the meme stocks, so it is possible. It wouldn't be priced this way if it wasn't possible, right? In other words, you'd be saying that the market makers are quote unquote stupid if they are just giving away money at this, and that's just simply not the case. So just don't like go put your retirement funds in this by any means, but I think it's worth the risk. And now we're back up to that 395 level. I'd like that better. Let's send it to the what if calculator so that we have it in there. And let's hope that we can execute it, at least get it executed in here at 350. But 200 divided by 500, we're looking at 40% after it's already tripled. But then again, here's what I look at. When I look at things like this, I mean, when it hit 300, you can make the same argument. When it hit 400, you can make the same argument. Now we're at 500. Now it's in the news. And now you're going to have other people piling on, the fear of missing out scenario. And I think that's what really drove it the last couple of hundred points. We got the earnings. There's no way to judge if this move is real, but that's a decent paycheck for that risk reward going into earnings. All right, I'll let it go. Don't do, that is a totally speculative trade, and I'm mainly doing it because the earnings is also driving up that implied volatility to go along with the stock movement. All right, now let's go back to a real stock. This one seems like a game show, but let's go in and look at a real stock that we wanted to talk about today. I'm going to look at CME. So the CME announced earnings recently, and the stock has quietly been an outperformer in the marketplace. It's up $1 today. And we have a lot of companies that are going to be announcing earnings this week. As a matter of fact, we have Tesla that's going to announce after the close on Friday. And then we also have GE Vernova, which is going to announce on Wednesday before the open. So I think we're going to look at Tesla on Wednesday. We'll look at it and see where the stock is at. But CME announced earnings, and I don't mind getting long some CME. The Chicago Mercantile Exchange. And this stock I have actually been trading on and off. And we finally got a little bit of a pullback. And we're right at these most recent highs before the breakout, right at the 290 level. And CME is getting into the prediction markets. They make markets. They're a threat to companies like even DraftKings. You never used to mention them in the same breath, but now that is feasible. Robinhood is another stock that's in that range that CME is actually taking on, in that they're very good at making markets. And if they get into the prediction markets and that area grows, right now they're staying in the financial products, but who knows where they might go next. But with that mentioned, the 290 level is just a very interesting level. So I wouldn't mind either getting long the stock or buying a deep in the money option contract right here. So I'm going to do that. We already had the earnings, and so I just want to put in a paper trade uh, to continue with our portfolio of longer dated option contracts. And we're going to go out to we'll go out. I kind of wanted to go out to October, but we'll do the December or September contract. And we're going to look at 151 days out. We're going to go simply down to we're going to look at the open interest, not a ton on this. We're going to go to the 76 strike, and we're going to buy this option contract, the 270, going out 151 days out to the September 18th expiration. A little less than half a year. I would have liked to go out to October, but they don't have it. And I don't want to go all the way out to December. It's too far away. So let's do this. We'll click on that. And $29, $30. All right. So yeah, 10%. The stock is a little less than 300, but obviously we paid $30. So you're looking at managing your risk in that way and still getting something that acts a lot like the stock. So we're going to buy this 270 strike call. Now you definitely work this. You'd want to put this in at about 29, see if you can actually get executed somewhere in that range. Paper trading platform. So I'm going to bump it up a little bit. $29.95 is a mid. We'll go $30.50. Let's go $30.50 to buy one option contract, one call option deep in the money. And just so that we have some longer term trades on stocks that have outperformed the market, that have done really well. And CME, the sell-off after earnings makes this a potential buy right at this level, at the 290 level. And I don't even mind CME 2 is a solid short put spread. If you don't mind buying the stock, either selling a put to buy the stock or selling a short put spread, just as a bullish trade, as a way to get bullish on CME. All right. Now let's go in and let's get one of our butterflies off. Let's look at GE Vernova. Real strong move on this stock, but we're right at that 1,000 level, right? GEV, once again, very strong stock. $1,000 of a big round number. Going into earnings, I think that there's potential for the underlying to sell off. So I want to look at going deep out of the money, and I'm going to start by looking at an open or a skip strike butterfly as a bearish trade, as opposed to a short call spread. And we're going to look at that. Now, that's basically saying that if the market comes up a little bit, we're still okay after earnings, but we're going to try to bring in a decent net credit to the account by doing that trade. So we're going to go all the way into the short-term option. They're announcing on a Wednesday. You're going to have all day Wednesday, all day Thursday, all day Friday. Here's the expiration that we're going to look at is April 24th. We're right at $1,000. So if we do a quick expected move, let's throw it in just to show it here. We're going to go at the 1,000 level. Let's buy the call. Let's buy the put. Oops, I got two of those in there. And we are trading at $61. So the expected move up until this Friday, after that earnings report on Wednesday, is 60 points. So 1,060 is an interesting area of the target. So we are going to remove this trade. And remember, you buy the most at the money call, the most at the money straddle, gives you some expectation of what the underlying stock will do after the earnings report, or at least until that expiration date, which is this Friday, April 24th. So we're going to look at buying the expected move, which is going to be about around a 20 delta here. We're going to buy that option contract. We are then going to go 20 points out of the money. We're going to sell two of the 180s, and then we're going to stop short. We're going to buy the 190s. Too many legs. All right. Did not clear out my long straddle. Okay, 160. Let's go 10. Let's make sure that the 10 is a net credit. We'll sell 2 of these, and then we'll stop short on this. Net debit of 95 cents. Let's go a little bit. 10, 780. I guess we'll look at the 1050. All right, so we're going to look at the 1050 and we'll sell the expected move right there. 1, 2. And buy this one. Man, not getting a credit out of that either, huh? Real wide bid-ask spread. 90 cents net debit. Well, let's look on the other side. Let's lean to the put side then. Let's go look at a long put spread. I wanted that to be a 90-cent net credit, not a net debit. So let's look at 60 points to the downside. We're going to buy the 990. And then we'll go 20 points this way. That gets us to a delta of 35. And we'll sell 2 of these. And we'll go down 10 points here. And we'll buy 1 of these. All right, don't mind that. So this is usually the case. If the skew isn't working to get a skip strike butterfly done for a net credit, then usually the open wing butterfly looks good. And it's just all about the skewing of volatility around earnings. Now, I don't mind this trade. I really wanted to sell something for a net credit. I want to lean bearish, but the stock's been really strong. We're hanging right out at that 1,000 level. And I think that even if they have a strong earnings report, this is going to be an opportunity to sell off the stock a little bit. And so that's what my goal is here on GE Vernova, is to get bearish with minimal risk. I like this trade, but I really like the open wing butterfly, but we couldn't get it done. I don't like the range that it was at, and that we couldn't get that done for a net credit. So here we're going to look at buying the 990 strike, selling what's the middle strike, 970, and buying the 960. So the long put spread, the workhorse of our open wing butterfly, is 20 points wide. The short put spread, which is protecting us and lowering our risk by bringing in a net credit, is only 10 points wide. 20 minus 10 means that anywhere below the lowest strike, the 960 strike, right here where my cursor is at, excuse me, anywhere below that, it's got to trade for $10. If we put this on for $5.45, that means that we can make $4.55, and it's showing that that's what it grabbed. That's the price it grabbed when it came in. So $4.55, you can highlight it up here, anywhere below that level. I don't mind this trade either, as a 1 by 2 by 1. If you got to realize your total risk is $5.45. But what I don't like as much about it as compared to the open wing butterfly is that if the market just opens flat and it doesn't move much, we can still lose that $545. But we're going to have a few days for it to live. Remember, we're doing it on Wednesday. So you got all day Wednesday, all day Thursday, all day Friday. It's not like if it was an announcement on Thursday. I don't mind this trade at all. The price is right. You're getting paid for it. The vol is there. Yeah, we're gonna make this the official paper trade, $5.45. It's moved already. Let's put it in at 5. Wide bid-ask spread. So you got to work this order. Send one long butterfly in at a net debit of 5 for the day. And boom goes the dynamite. There it goes. So we got our 2 orders in. So let's look at our car short spread. So we're 200 points out of the money, selling this for a net credit of, what was the net credit? Of almost $4. I would work it. I would want $4. I don't think I would adjust my trade. If I didn't get $4, I wouldn't put it in. Say it's 475 right now. It bounced down to a net debit of 350, but I would leave this in at $4, and I need $4 for this trade. Now, I don't just leave it in all day. You put it in, come back, and you take a look at it 10 or 15 minutes later. You don't just let the market move 100 points in either direction. But I think $4 is a very fair price on a 20-point wide spread, 200 points out of the money. Going into their earnings report on May 8th expiration that we have. So let's go and CAR. 18 days away, right? May 8th, 18 days away. And I think in that earnings report right now, and it's not confirmed, so I could see them moving this earnings date, which if they moved it, it's on the 6th. If they actually moved it beyond the 6th and went out, beyond the 8th or whatever, then that would actually help our spread out. So that would be a good thing. But they might pre-announce because of the movement in the stock. I could see the company doing that too. So keep that in mind. This is a very risky trade, but it did, it wasn't that long ago that it traded at 320. Interesting, just interesting overall. Interesting 2 trades. GE Vernova, we got long CME. We added to our deep in the money paper trading portfolio, and this Wednesday we'll come back and we'll probably look at a trade in Tesla. I don't mind Tesla at this point in time, but it's all about the conference call with Tesla. So we've had some chop. Stock has came back down a little bit of, it's down today, but a little bit of a bounce recently. No real reason why I can see right here that we decided to bounce at that level, 340. Yeah, I don't even see it from going back to there. But yeah, we'll look at Tesla. So Tesla is going to be the trade on Wednesday. And that's it for this edition of Options Guide TV. I didn't take a peek. Look out. Yeah, that'll be it. That's it for today's show. That's it. We'll look at Tesla on Wednesday and look at that going into earnings. We'll see how GE Vernova did going into that earnings report. We're going to keep an eye on CME. We're going to add it to the paper trading portfolio. We'll keep working that position, just like we did in Netflix. Netflix actually sold off a little bit after earnings too. We did that last Wednesday, but Netflix is trying to bounce back, just kind of like what I'm expecting in GE Vernova. We did a bullish trade to start with, a little bit of a bullish trade on Netflix, and now the stock has bounced back. It's still looking extremely strong at the 94 level. Still like the stock. Inside our position, we had a Netflix. Here was our paper trade that we put on. We got this riding until the end of the week on the 24th. We're looking for that stock to move back. Right now, it's not going to be trading for much. We're hoping that we can get that move. And then we got our deep in the money call and our options. So we still got our position rocking and rolling. All right. That's it. This for real this time. My name is Brian Overby, known as the Options Guy, here on Options Guy TV. And we'll be here next Wednesday inside the Trader Hub, hub.trader.com, for the next edition of Options Guy TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.